Everybody get up!
And welcome back to the show this morning. It is 6:34 as we get underway. Futures lower this morning, down about 700 points on the Dow after a 1,000-point rally yesterday. I say earlier today, you like a little volatility on the side of that. This type of volatility makes it very tough to manage money.
It does, and it stair steps up, stair steps down. You don't get a whole lot of direction one way or the other, and it's just like yesterday. It was up like 965 points on the Dow in the morning. Yeah. Then you lose all those gains, then it pops back up on optimism around this payroll tax.
Exactly.
And really, I think that's all that there's to be optimistic about at the moment.
Well, that's true, and again, this, and it was interesting because, like I said, Steve Mnuchin was apparently on the phone yesterday, very late afternoon, right before the close of the market, and talking to the heads of the president's working committee on financial markets, and that's the acronym for the plunge protection team. Everybody knows and loves. But it didn't really have much effect. And again, I think markets are really kind of starting to struggle with and who's been extraordinarily quiet at this point. Now Jerome Powell, head of the Federal Reserve, is part of that plunge protection team, right? And it's interesting because he's been so very quiet as of late. He did cut rates Tuesday, not yesterday, but last Tuesday. They cut rates by 50 basis points. But not a lot of commentary really coming out from the Fed. They generally trot their kind of Fed members out to drop little hints about, kind of what the policy thinking is, what the strategy is, those type of things. But they've actually been pretty quiet. There hasn't been a lot of conversation from the Fed saying, hey, we stand ready here. We're going to do, QE if necessary, blah, blah, blah.
What could they possibly do?
Well,
what could they do?
But, the biggest part of the Federal Reserve is they have three primary tools at their disposal. There used to be two, now they have three. The two is that they could use lower interest rates, right? Lower the Fed funds rate and try to supply lower rates to the economy. People go borrow because rates are low. They go borrow money and they spend it in the economy, right? So that helps support economic growth. Well, unfortunately, what's happened over the course of the last decade is that they maintained zero interest rates for so long that the effect of zero interest rates no longer has an effect because people have already borrowed and spent just about everything they're going to do. More importantly, one of the big benefactors of lower rates are people refinancing houses or buying cars, right? Those are big inputs into the economy. Well, the problem is most people have bought houses, but prices have gotten so high on houses because of low interest rates that's made housing unaffordable for a lot of individuals. And there's a point to where banks are not going to loan money for 30 years at a lower rate. And if you look at the 30-year mortgage rate, it really has become very sticky, even though rates have been coming down. Because if I'm a bank, if I'm Danny, and somebody went to Danny and said, "Hey, would you loan me money for 30 years at 1.5%?" No, I got to beat inflation, right? So, there's a risk on 30-year money to where banks are simply not going to loan it to you for any less, and so you're not going to get the same impact out of lower interest rates. So their other tool, of course, is quantitative easing, and that's buying back bonds, but. That was one thing in 2009 when you had a completely blown out economy. You just came out of recession. You had super negative sentiment. And the Fed balance sheet was only $900 billion. So you went from $900 billion to $4.5 trillion. Well, here you are today. And, oh, by the way, in 2008, the Fed funds rate was 4.5%. So 4.5% to zero, right? So today, here you are. Fed funds rate is 1%. Your balance sheet is almost $4.5 trillion. Where are you going to go from here? Yes, we can do another $4.5 trillion of QE, but you have less effect into the economy because you don't have a blown out economy. You don't have a deleveraged consumer. You don't have cheap valuations in stocks. You don't have the environment that you had, high unemployment. You don't have those abilities to reverse the economy that you had back in 2009. Today, right? So QE is less effective. So your other tool, the final tool, of course, is forward guidance. And that's the thing that's missing. which is their verbal guidance on all this. That's where they're coming out saying, hey, we're going to do this. This is what we're thinking about. Here's what we can do. And that messaging to the markets has been one of their primary tools to help, keep markets supported over the course of the last couple of years. Remember, in December of 2018, the market fell off the cliff, just like now. We were down 20% in a couple of months. And the Fed was trying to hike rates then. They were trying to reduce their balance sheet. And then they said, whoa, no, we're done. Change of plans. Don't like the way that turned out. So we're thinking about maybe lowering interest rates, and we're going to, stop reducing our balance sheet. And the market started to recover, right? That they didn't do anything at that point, but they were talking about it. And that verbal guidance gave the market support. So what's interesting is over the last couple of weeks with all this volatility that's going on, hasn't been a lot of verbal guidance.
No, it is interesting. And markets don't like that unclear message or the no message at all.
Lack of message, yeah.
And that's what's going to be tough moving forward. And you got to think about this. If this is an interesting thing, because typically in this environment, when you come out of a recession, it's just like an individual. Maybe you get in a little bit of debt. When things get better, you pay that down. You start to fortify your household again. You increase your savings. That didn't happen with the government.
Right.
The Fed just completely went the opposite direction. They just never stopped.
Right.
And so they just said, oh, well, we're going to keep on going. And it was interesting because under Bernanke and Janet Yellen especially, they had many opportunities to come back and say, okay, let's start stepping this back a little bit. And we knew that unwinding this was going to be very difficult, which is exactly what you alluded to. In 2018, we started to try to unwind this, and the market reacted terribly. But what did you expect when the market reacted so well when you actually put all this stimulus out there and then you pulled away?
But that's a great point. What Bernanke should have done is after the first round of QE, they took it off in early 2010, and the market started to correct, and he panicked and came back in and started doing QE2. He should have just let it correct. Yes, the market today would not be where it is, right? We'd probably be maybe around 2008 highs, right? Maybe a little bit higher. But we wouldn't be where we are today. But the economy would be a lot healthier. You would have, because we would have worked through a lot of the debt problems, you raise interest rates back up. Yes, guess what? Some businesses go out of business. Guess what? Some major banks go out of business and they get absorbed by other companies. That's capitalism at work, and that makes your economy healthier over time. And so you allow the system to work, and then use your Fed policy tools to try to just mitigate some of the impact of that unwinding of the excess leverage, the unwinding of these criminal banks, criminal enterprises that we call, J.P. Morgan, but Wells Fargo, we allow those things to unwind, and everybody's like, well, can't let a bank fail because they're systemic. Well, yeah, but if you let J.P. Morgan fail, Frost Bank, Prosperity Bank, all your mid-sized regional banks, they pick up those customers, right? They become bigger, and you diversify your systemic risks across the economy. You actually make a stronger financial system that way, but we didn't do that because the banks that were bailed out, guess what, are the member banks of the Federal Reserve.
Well, of course. I mean, they're the ones pulling the strings, right? They're the puppet masters. And so it's unfortunate it goes further than just the banks. It's many different institutions or industries that do have that safety net underneath them to say, well, these guys do business with too many people. It'll impact too much. And that's the problem. There's no self-responsibility. And that goes even a step further. And we think about, you guys are going to do a payroll tax cut. Look, I'm all for it, right? Everybody wants more money in their pocket.
Yeah.
But think about
trust me. Let's just, how about this? Tax forgiveness, period. No income tax, no payroll tax. The whole reason our founding fathers came here to start with was no taxation without representation. Let's go back to that.
Well, Nancy Pelosi did say that, they will not shut down the Congress because, somebody's got to lead this ship. You didn't see that?
I didn't see that.
Oh, if only they would shut it down.
We've shut down the government before.
I know.
And everything ran just fine.
That's right.
I'm just saying.
I think the worst part about it was the parks. National parks had some issue with trash and things of that nature.
Yeah, but what? We could privatize the parks.
And it'd probably be ran much, much better.
Exactly. All right, quick break. We're back.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.